Welcome to Candy Mentor. Today, let's decode the intricacies of stock-based compensation under US GAAP and IFRS from an interview perspective. If you're aiming for a role in finance or accounting, understanding these differences is crucial. We'll break down the key points to help you impress your interviewer and stand out in your job search. Definition and scope. Stock-based compensation involves granting equity to employees as part of their remuneration package. Under both US GAAP and IFRS, it encompasses shares, stock options, and other equity instruments. The primary aim is to align employee interests with those of shareholders. However, the standards differ in their approach to recognition, measurement, and disclosure. Understanding these nuances is vital for professionals navigating international financial landscapes. Recognition criteria. In US GAAP, stock-based payments are recognized based on the fair value of the equity instruments at the grant date. IFRS follows a similar approach, but emphasizes the vesting period more prominently. For interview purposes, highlight your understanding of how both standards require recognition over the vesting period, ensuring expenses reflect the service period of employees. Measurement of share-based payments. US GAAP and IFRS both use fair value measurement, but with key differences. US GAAP mandates the use of option pricing models like Black-Scholes or binomial models. IFRS allows some flexibility, especially for non-public entities. Master the calculation methods and differences to discuss in interviews, showcasing your ability to handle complex financial instruments. Modifications and cancellations. Modifying or canceling stock-based compensation can alter financial statements significantly. US GAAP provides detailed guidance on recognizing incremental costs due to modifications. IFRS, meanwhile, treats modifications as new grants if fair value increases. Prepare to articulate these differences clearly, demonstrating your problem-solving skills in dynamic business environments. Employee versus non-employee transactions. US GAAP differentiates between employee and non-employee transactions, impacting how compensation costs are calculated. IFRS, however, applies the same principles regardless of the recipient. This distinction is crucial for interviews, as it affects how companies report expenses and manage equity compensation plans internationally. Tax implications. Taxation differs significantly under US GAAP and IFRS. While US GAAP considers deferred tax assets and liabilities based on temporary differences, IFRS requires a more integrated approach, considering both current and deferred tax effects. Understanding these implications is key for candidates aiming to provide strategic tax planning insights during interviews. Disclosures. Both US GAAP and IFRS require extensive disclosures regarding stock-based compensation. However, the specifics differ. US GAAP tends to be more detailed, requiring additional information on assumptions used in valuation models. IFRS focuses on clear, concise communication of potential impacts on financial performance. Be prepared to discuss how these differences influence transparency and decision-making. Practical application and real-world examples. In interviews, discussing practical applications and real-world examples of stock-based compensation can set you apart. Highlight cases where companies have successfully navigated these standards, or where missteps have led to financial restatements. Demonstrating an ability to apply theory to practice will underscore your value as a potential hire. If you found this helpful, don't forget to like, subscribe, and hit the bell icon for more insights from Candy Mentor. Drop your questions in the comments, and let's master accounting standards together.